Hey y'all, Seth Bradley here. Thank you so much for tuning in and spending your valuable time learning with us. Absolutely appreciate each and every one of you. I've got a small ask. If you'd please just take a few seconds and leave us a rating and review on Apple Podcasts or wherever you're listening from, it goes a long way in landing the best new guests for our show. That's it. Thanks again. Let's go. All right, super stoked to have my good friends Bob Fraser and Jim Maffuccio on the show today. We have actually partnered on deals before, so I love these gentlemen. I know they mean business and they know this industry inside and out. Bob has 20 plus years of experience in finance, investing, and technology, and has held several CFO and CTO positions over the years, and is a former E&Y Entrepreneur of the Year winner when he founded a technology company that became one of the fastest growing companies in the Midwest, reaching 250 plus employees. Jim has over 30 years of experience full-time in real estate investing and is an award-winning developer. He's an expert in mortgage notes and other real estate asset classes. He received a civil engineering degree from Louisiana State and started his career with Exxon, gaining extensive project management experience. All right, folks, let's jump in.
This is the Passive Income Attorney Podcast, where you'll discover the secrets and strategies of the ultra wealthy on how they build streams of passive income to give them the freedom we all want. Attorney Seth Bradley will help you end the cycle of trading your time for money so you can make money while you sleep. Start living the good life on your own terms. Now, here's your host, Seth Bradley.
Bob and Jim, what's going on, guys? Welcome to the show.
Hey, Seth. Great to be here.
Yeah. Absolutely. Super excited today. Guys, let's just jump right in. Tell me what's your story, how you guys formed a partnership. Take it back as far as you want.
I'll let Jim take this one.
He's only saying that because I'm older. I go back further, but I won't take you back that far. So anyway, so I actually graduated college as an engineer in 1979 and went to work for a large corporation as a civil engineer doing project management. Did that for about 5.5 years and just really, I was the square peg in the round hole. I had to get out of there. The entrepreneurial urge kind of got clicked on. And so I got my real estate license and really jumped into full-time self-employment in 1986 and haven't looked back. Haven't gotten a paycheck from anybody else since then. And so pretty much got involved in projects, residential infill developments in Southern California. And as a small player, that's kind of a ridiculous business model to pursue in Southern California. I'll spare you the gory details, but suffice it to say, I went through 2 really complete washouts, having built up a really decent net worth and done some successful development projects. All it takes is one bad cycle. And if you're overextended in a bunch of land and you have debt against that land, you can't outrun the alligator. At least I couldn't. So I got it handed to me twice, once in the early 90s and then again through the mortgage crisis. So I found myself in, 55 years old, had just moved to Kansas City from California, really had to start over from scratch, started flipping houses, completely broke, by the way, 5 teenagers under roof. And I kind of had an epiphany in 2010/11 that, I was on the wrong side of the debt equation. I needed to be the lender, not the borrower. There's a good story to that, but I'll just give you that short version. So I discovered this whole world of buying distressed or defaulted mortgages, and they were everywhere, of course, because the institutions were hemorrhaging these, what they called toxic assets. And of course, one man's toxic assets are another man's treasure. So I saw the treasure in it. And after spending some time, doing some house flipping and short sale negotiating, decided to really focus all of my real estate background and project management into buying distressed second mortgages is where I started. So I had really just gotten started, a little mini beta test. And my next phase was to try to build this thing out and go raise capital, which I can do, but to be honest with you, I'm good at promoting, but I'm not that great at building systems around it. So pretty serendipitously, Bob Fraser and I had known of each other, but had never really spent time talking. He called me up one day in 2012 and said, "Hey, let's get together for coffee. I'd like to find out what it is you're doing." And so I I kind of explained the model that I'm buying defaulted second mortgages. And he first wanted to end the meeting because he thought, you're insane. Why would you do that? And I said, give me 5 minutes to explain why. And I did. And, the short version is he saw it, he got it. He's a smart guy. And within months, he said, hey, I want to jump in and do this with you. So we formed Aspen Funds made the decision to at the end of 2012 and formed it officially in 2013, and have been off and running on this thing ever since, and just building and growing and loving it. So I'll let him jump in.
And I'll fill in my blanks. I was a computer programmer. So, okay, many moons. Computer Berkeley, summa cum laude graduate, worked in programming for a long time, then built a tech business in the late 90s, the dot-com era, $44 million in venture capital, ended up, having 300 some employees. I became the fastest growing business in the Midwest region of the United States by revenues in the late 90s, and win the Ernst & Young Entrepreneur of the Year Award. And then it blows up. And I lose everything. Okay.
First it blew up in a good way, then it blew up.
Right? Yeah, exactly. Right. We argue about craters, and I always say my crater's bigger than your crater, and after that, I realized the kind of the vagaries of the stock market, right, and the emotions of the stock market, and it's not a place I wanted to live. And so I worked at CFO work for a while, and then met Jim here, who's telling me about this debt business. I'm like, man, this is so good. It's uncorrelated to the stock market. It is more correlated to real estate, but it's really debt, which is a completely different animal than equity in real estate. And so you can get a modicum of safety, you can get security, you can get income, get cap gains. And I realized this was really kind of a superstar asset class. And so, when he told me, what he was doing, I first was saying, okay, let's end this meeting now. But then once he explained it to me, I about fell out of my chair. It was so good. And so today we've been doing this 9 years now. We have 5 mortgage investment funds. Our flagship fund is passive investment. It's, we become the bank, we buy notes from, when you buy a house, you get a mortgage. Those mortgages are sold. If you ever get the letter in the mail that says, okay, send your check now to this company instead of that company, that loan was sold and you don't know. So we're guys behind the scenes. You might be sending your check to us, who knows? And we buy that mortgage, and we become your bank, and we get the checks in the mail. And so that's our model is checks in the mail, and then we pass those on to our investors.
Awesome. Yeah. We're going to dive deep down into that. But I think the moral of the first story is entrepreneurship is not for the faint of heart.
Yeah. Well, yeah, we're kind of passionate about understanding the times that we're in. And, in the dot-com era, it didn't matter what your dot-com was, that boat was floating, and after, post-dot-com era, it doesn't matter how good your dot-com was, it wasn't floating.
It was sinking.
And so we really want to understand what the times and seasons are, and know where to be, which baskets to be putting our eggs in. And so we're passionate about economics. We're passionate about macroeconomics. We're passionate on looking at the trends and and really finding the things that go with the flow. And in our case, debt investing is counter-cyclical, right? It's super easy to find a cyclical investment. How do you find a counter-cyclical investment? Well, distressed debt certainly is counter-cyclical, and they're very rare, very hard to find. And a good portfolio is not just, it's diverse in lots of different ways, including macroeconomically.
Yeah. So how exactly did you guys get started in that? I mean, how did you find that? And most people, they look at real estate as kind of a first thing, and they'll start flipping houses because they see it on HGTV. I mean, how did you kind of look? And Jim, you had said that you've done some house flipping and things like that too.
So
how did you find note investing?
Yeah. So okay. So after the 2008 mortgage debacle, it was carnage everywhere you looked. And so I'm sitting there and I'm like, it was a frustrating season because my engine inside was revving up, but I had no gas in the tank, a broken down vehicle, but I'm seeing opportunity everywhere. So most people, with the low hanging fruit was you go around and you look for boards on windows. Those are, those would typically be bank owned properties, or REO, they call it. So that had already been foreclosed on, and these institutions had them and they had to get rid of them. So everybody and his brother became a flipper. Some people that actually still had money then became landlords. They'd buy these houses, fix them up, put a renter in it. And I jumped into that because I had to figure out a way that I could definitely drive to a paycheck. And that was it. I mean, I knew I could get my hands on a house, bring the people in, fix it up, get a hard money loan, whatever, and make some money. So I started there, but then I realized that this is not scalable at my level. And a lot of people were jumping in. So then you move one step further upstream and it's like, okay, you go to foreclosure auctions and you bid on properties there and you get them before they become REO. And then you're the guy that gets it as the REO, and did a little bit of that. And then but it just, again, everybody was going there. I always like to go where the crowd isn't.
He wanted to go upstream, right?
So one step further upstream, of course, is what we call pre-foreclosure, and that's short sales. So I'm pretty good at negotiating and pretty good at figuring out a deal. Then the regulators kind of came in and started really making it weird, and then so my final, and this all happened in a short period of time because I was seeing it all at once, but I had no idea how to get to the upstream, which is buy the loan while it's in default, but before it's been foreclosed. So nobody, there's a limited number of players there. So literally, I went to a conference, a distressed debt note buyers conference in Denver in 2010. And I mean, the lights just fully came on. And so I started studying it and realizing I really have all the skills, because it's still real estate at the end of the day, understanding real estate and understanding the financing. So that's kind of where I decided I need to get my ADD self out of the way and focus somewhere. And I decided to focus on the upstream, buying the debt, and then further focus within the niche of buying the second mortgages. Because again, there was less people looking at it, because it sounds insane at first until you look at the numbers and the leverage that you get and the very low price points that you can get in and the multiples that you're able to make. So that's where I stuck the fork in first. And then, Bob and I hooked up, and it was just great timing, and we just made decided let's build a business.
We bought a portfolio of 106 loans from a hedge fund, and Jim partnered with, and worked those out, returned the money to investors, and then started our current open-ended funds that are running today. And the
rest is history.
Races.
Gotcha. So tell me about, you said second mortgages. Most people, as you had noted, think of that as that might be a risky position to be in. Tell me why it's not.
We are so glad everybody hates second mortgages.
Yeah.
Super pumped.
You shouldn't buy them. You shouldn't.
Yeah. And whatever everybody hates, you can guarantee they're going to be what? Yeah. On sale.
Yeah.
And there's no such thing as a bad note.
I'll just give you a typical second mortgage that we would buy. Okay. So it would be let's say a house is worth $200,000 at the time of we purchase it, and there's a first mortgage of $150 against that property, or let's just say $175. So there's really only $25 marginal equity above that first. And then we have this $70,000, and that's a typical principal balance of a second that's on top of the first. So the property's underwater from the borrower's perspective. But we look at that $70,000 and say in the day, we would buy it for $5,000, sometimes as low as 1% of
you're buying a $70,000 receivable for $5,000.
Yeah.
$25,000 in equity on it.
Yeah. And you look at it and most people would say, yeah, but you're never going to collect on that. And we say, well, we'll collect something on it. So here's what happens. So now we're in position here. And now the real estate market, and this thing works even if the market's not going up, but now the real estate market starts going up. So our piece of, our value in the equity in our position is growing as the price of the property goes up. The other thing is the vast majority of the time we buy these non-performing seconds, and the first is performing, because look, people will stop making their timeshare payment. They won't stop making their car payment. That's usually toward the very end, but they'll stop making their second mortgage payment because they figure, and then after like 3, 4, 5, 10 months, they haven't heard from the lender anymore. They figure, hey, I'm free and clear, but they won't stop making that first mortgage payment because they think Well, the first mortgage can foreclose, but nobody else will. Well, that's where they're wrong. So anyway, the value of the property is going up. That adds value to our asset. They're paying the principal on the first mortgage down. That adds value to our asset. And they continue to accrue interest that they owe us. That adds value to our asset. So we're sitting in a pretty good position, subject to there are some statutes of limitation and things like that, but it's just a fantastic model. It's like having a call option on the equity and the property that doesn't expire and gets more valuable with time rather than less.
So I'll give you even a simpler picture. Okay. Performing mortgage. This guy's paying on the mortgage. There's a first and a second, $300,000 house, $100,000 first. Say that $100,000 first is a 4% interest rate, and it's covered by a $300,000 house. Maybe you can buy that at par. You're going to pay $100,000 for a $100,000 note, and you're going to earn 4%. Okay, I'm not interested in that. Yeah, whoop-de-doo. Okay, but there's a $100,000 second. Okay, and its coupon, it's not 4%, it's a 7%. Well, I'm already almost doubling my yield, but I'm buying that. Maybe I can buy that at a 30 or 40% discount. So instead of paying $100,000 for this debt, I'm paying $60,000 or $70,000. And so my coupon is 7, but my yield is 10, 11, 12. You follow me? So and is it less safe? I've still got $100,000 in equity above me. Is it less safe? Marginally, not really. In fact, mathematically, I can tell you exactly what that is. Because we do that. We actually do the full math. We do the full mathematical underwriting of what's the intrinsic value of this note based on all possible outcomes. And they sell at discounts to that. Okay. And here's the other thing. Not only do you get higher yields on seconds, but when that loan is paid off, so that borrower sells that house, right? So they go sell that $300,000 house, or they refi it. Both the first and the second get paid off by the new lender, right? So I get paid off. Well, how much do I get paid off? I get paid off my full $100,000. No one knows what I paid for this loan, right? So the borrower owes me $100,000. I paid 60 for it. So I make a $40,000 profit. So I make a 11% yield until I make a, whatever cap gain,
$40,000 profit,
a $40,000 profit. So it's literally win in cash flow and then win on cap gain. So yeah, I really hope people continue to hate seconds.
Man, I love that. That brought up just a lot of stuff that I didn't even think of. I'm not that familiar with note investing, but you can get them, especially the seconds, you can get them at a great discount, a higher interest rate. So that means higher yields, higher cash flow. Right. You've got the equity growth as the first is paid down, your note becomes more valuable, and then you get the full repayment upon refinance or
plus sale. Recovering your discount.
Yeah. And then you had mentioned that you have it underwritten to a mathematical equation. Basically, you have an underwriting sheet that can kind of let you mathematically decide whether it's a good investment or it's not.
Yep. Totally. Yeah, it's super hidden. Not a lot of people know how to do it. And it is complicated. It's like everything you have to, all the decision-making process you would do in real estate, you still have to do. Yeah. Plus, you have to add a financial calculus on your mortgage, plus a financial calculus on the senior mortgage. Okay. And then plus a legal analysis of your state and the foreclosure law. So it's much more complicated.
It's a really sweet deal. And the biggest challenge with it, well, there's two right now, Seth. One is for us, the biggest challenge is it's a limited opportunity. A lot of these seconds never see the light of day. So deal flow isn't on a continual growth trajectory. And we knew that was coming. And that's the second challenge of it is, and especially to enter the space today. And I'll just be 100% transparent. If it were today with the regulations that have crowded in and the statute of limitations rules and then on top of that COVID, which we've navigated our way through, without really much damage at all. We've actually grown through it, but the thing has changed so much over the last 9 years. I would not enter into this space today as a small player. We've gone through the pain of getting licensed. We've got a national bank that serves as our trustee. And I mean, we've been inspected by agencies pretty deeply. So we've built a really a sophisticated and compliance minded organization, which is where you want to be in this space. It's not a place for mom and pop. There's too many. I mean, you can become a felon by literally by buying a loan in the wrong state if you don't know that. So it's pretty shark infested waters, but we've grown up with the sharks, and so we can swim with them. But this kind of leads into our, the reason for our, it's a transition, not that we're leaving one and moving to another, but we're adding, because again, back to our original vision, as Bob mentioned, what we really want to do, and the need we're serving needs there. But the big need we really want to serve is we really want to help, and I think it's yours too. We want to help people find a way to get some of their portfolio out of Wall Street into uncorrelated, opportunities that can be very smartly underwritten, very capital protective, and make, historically decent returns, and be counter-cyclical and not be tied to whatever, person is occupying the White House and what he says or falls asleep during or anything else. We're just kind of in our own world. We went through COVID and all of our numbers are going up. When the stock market tanks, we look at the value of our portfolio. Did it go down overnight? No, it's just zipping right along, So we want to help people get into, along with us, other passive investment vehicles. And we have pretty deep experience in vetting not only deals, but vetting sponsors. And so that's really our growth trajectory right now, is opening up the tent and, letting some other people into the whole passive investment and alternative investment world.
Attorneys, doctors, passive income seekers, I'm talking to you. I remember investing in my first passive real estate deal, the anxiety, the uncertainty of what I didn't know, and what I had never done before. It was a lot of money being wired to someone I barely knew. Now, it all worked out, but that's not always the case. I would have never invested in that same deal today, now that I have the knowledge and the confidence to know how to invest intelligently. And now, with a combination of uncertainty and a flood of newbie sponsors in the market, how do you find the true experts that will perform and make your investment successful? For those of you out there looking to learn how to invest passively in syndications, we've been behind the scenes working on something very special. You don't have time to go through a 6-month course or to try to make a program designed for deal sponsors work for you. You want to be a passive investor. Focus on your career and your family, but add cash flowing, appreciating commercial real estate investments to your portfolio, so you can practice when you want to and not because you have to. We've built a powerful passive investor program designed to teach you everything you need to know, but nothing that you don't. It's a 4-week program, but if you really want to make moves, it can be completed in just a few days with ongoing support as you make your investment decisions. Passive Income Pro is enrolling now with a very limited number of seats for each cohort, so you can get the hands-on attention that you need. Go to passiveincomepro.io to learn more. Yeah, that's what it's all about. It's about trying to figure out a way to create your own economy, right? To be able to take back a little bit of control rather than investing in stocks, bonds, or mutual funds where you have no control. You have absolutely no control, as Bob, as you had went through in your crater, so to speak. You lose control of that. And when you invest in real estate, or you invest in alternative investments, or you invest in small businesses, you take a little bit of that control back.
Let me just make a little point along these lines. So I just did a little research on REITs. So people think REITs are real estate, right? You go buy a REIT in the stock market, people think it's real estate. It is not real estate. Okay, so I just look at the top 8 REITs, the largest REITs out there.
So that's real estate investment trust for anybody that's listening that doesn't know what a REIT is.
And so you're buying this stock that is primarily investing in real estate. You think you're buying real estate. So I looked at the top 8 and I looked at their price to book value ratio. So the price is the price of the shares versus the book value, what they own in real estate. Okay. And it ranges from 2x to 21x. What that means is you're paying 21 times the value of the real estate.
Why not just
buy that? And if people think it's real estate, it is not. It is a freaking emotional roller coaster ride is what you're on. You're not in real estate. It's uncorrelated to real estate, or loosely correlated at best to real estate. So real estate is real estate. And so there's that's why, we want to really stick into alternative investments that are actually where your price to book value ratio is 1. Means for every dollar you're putting in, you're buying $1 worth of real estate. And that's the way you want to do this. And it's only through alternatives and through private alternatives.
Exactly. That's what your financial advisor will tell you. They'll be like, oh, you want to get into real estate?
Exactly.
Well, why don't you invest in these REITs? And then most people will be like, yeah, now I'm invested in real estate. Not the same thing. You're still subject to the public markets. You're still subject to emotion. It's not the same.
Well, that liquidity and that ability to put, $5 or $5,000 into that and have access to it the next day if you want it. The price you pay for that is that multiplier above the real value of what you're buying. So yeah, that's a big cushion that is subject to so many intangibles that, yeah, it's liquid, but the day you want out of it, it's like, crud, it's down 7% from last week. Well, what piece of real estate ever went down, except for like 2009 and 10, went down by that much in that time frame? So anyway, I think we're all kind of on the same page with that, and more people are discovering this world, and that's fulfilling to us, and it's very exciting. It's a really good time to be in this world.
Yeah. The quote unquote weakness of real estate is its illiquidity, but that might actually be a strength.
Exactly.
So, many of the folks listening are attorneys and doctors and highly paid W-2s. How do they get involved in note investing? Because you had mentioned that, it's shark infested waters. It's a complicated investment to get into for somebody that hasn't done it before. How would your typical investor get involved?
There are a couple note exchanges out there where you can go do your own underwriting and buy a note. You need to hire a licensed mortgage servicer. You need to probably have an attorney look at your state laws in the state you're buying that mortgage in, and do your underwriting. But that's not what we're definitely not recommending that, unless that's really for the guys that want to the cowboys that want to roll up their sleeves. Okay. And that's great. People that want to do that, more power to them. And we did, but we built the scalable model around it. The easier way obviously is to invest in a fund, that's got the experts that know how to do this. And if a note defaults, it's in their wheelhouse, it's no big deal. And, like that.
You can do it as a hobby. So to speak. I mean, if you're a professional, if you're a highly paid professional, you're probably going, we know people like this that maybe buy some reperforming loans from one of the exchanges and put it in their IRA, and just let it sit there and cook. And some people even will buy some non-performing loans and then just turn it over to an attorney and say, start the process. But, you really have to be selective about the state you pick. There are some states that are, like I said, you could be a felon for buying notes in some states, but you can do it. And we can direct people if they want to look us up on our website. We can direct people to some mentors that'll help you get started on a small scale. But typically it sounds like your audience are people that, don't really want to dabble in something. They have some significant money they want to invest passively, truly passively. There's nothing passive about buying loans, even if you buy quote performing loans, because as soon as one of them stops paying, yes, it's not tenants and toilets and trash, but you know what? It's lions and tigers and bears. It's attorneys, it's servicers, it's CFPB regulators, it's FDCPA violations. And so it's not a great space to be a mom and pop or to dabble in. And as Bob said, there are mortgage funds. That's what we run, and we're not trying to pitch to, but that's the way to get in with any kind of a scale. If you've got some capital that you want to invest passively, that's the way to do it.
Yeah. Awesome. What are some of the projected returns on your guys' funds? So feel free to pitch.
Our flagship fund pays 9%, and it pays monthly. So it's just boom, ACH into your checking account. And here's the crazy thing. Okay, you said the big bugaboo about real estate is liquidity, and it is. We actually have liquidity. Okay, so we have a portfolio of 1,200 notes in this flagship fund. All right, 1,200 notes. Well, guess what? They self-liquidate. It's like, imagine having a rental portfolio and, once a month, one of your houses sells itself. That's what happens. So these notes self-liquidate whenever a borrower refinances, which they 100% control, or they sell the home, which they 100% control. We get paid off. And by the way, it's a profit. We get paid off at a profit. So we just have these bunch of nuggets out there incubating, and they pop. Yeah. Well, so we have this massive liquidity flow, internal, organic liquidity. We don't have to go borrow money. We don't have to do anything. It's there. And so we actually pass that along to our investors. So as one of our investors, you give us 90 days notice, we ask for, although if you need it sooner than that, we'll generally be able to do that. We have a 1-year lockup, but after that, it's on any quarter, just ask for your money back. So what happens every quarter, we build up this pile of cash, and we basically decide, okay, are we going to send this back to investors for redemptions, or are we going to go shopping? And so, so for investors, it's really, so it's like a 9%, we don't want people to think of it as liquid as a money market account, but it's not a CD locked up. It's not a piece of real estate you can't sell. So a lot of liquidity. So yeah, that, but it's a, very popular investment. Our investors.
We actually have Bob would know the number, but a very small percentage of our capital at any given time is under redemption. I mean, most people want to keep rolling what they've got in.
Yeah, they're trying to put in more money. That's our.
It's really not. It's not. As Bob said,
we've never missed a redemption request. We've never failed or had to roll anybody in that. So not to say that could never happen. We can't make guarantees, but it's good steady income that's super well secured. And the revenues that the fund generates through mortgage payments and then through these payoff events or refi events keeps us way above, flying above the tree. So it's never been a problem paying our preferred return to our investors. And it's just a great model. We also do, and that's our income fund. And we also do some limited and very, very well underwritten hard money lending, which is just, your fix and flippers or somebody. We just finished underwriting one. We're going to be funding it tomorrow on a guy that already owns 2 apartment buildings out in he's in North Carolina, and we're closing a loan for him. He just needed money fast. I mean, it's high interest. It's 13% money, and he'll probably pay us back in 6 months. But it works for us because we continue to generate that revenue above our cost of funds, and so we have a very good, as Bob said, very good diversification of our types of loans, as well as geographically. We're literally, I think we're in over 40 states our assets are in. So we're not highly concentrated on the coasts where there's probably the most sensitivity to value fluctuations. We love the heartland. We love the flyover country. It's super non-sexy, but super predictable. And the fact of the matter is most of the underlying collateral properties in our portfolio, even if we had to take the property back, foreclose and take it back, they would rent for more than what the mortgage we were collecting anyway. So it would still be in what I would call a performing, not a cash flowing asset for a short window, but still a performing asset in a sense, right? Because it still has value. It's not losing value. So it's a pretty elegant model, and it's served us well.
Yeah. What do you do with the properties that you have to take back? Are you guys in the business of keeping those properties, or do you get rid of those as soon as you can?
Yeah, we actually very rarely have to end up with a property. It usually is gone before that point in time. And sometimes we'll sell the note as a non-performing note to somebody that feels like working it, So we look at all the available exit strategies. But we have been lately, because of the real estate market, of course, has really healed itself up from, when most of these defaults were created, very, very rarely. I mean, we have good equity. There's good equity above us. So that being the case, that means that the homeowner has something to lose too. Why don't they so we'll encourage them. Why don't you just put the property on the market, and, we all get out of this just fine, and sometimes we can even offer them a little discount on our piece to help facilitate the short sale per se. And so very rare.
In our flagship fund, I think we've had about 25 defaults that we had to exit.
Over the course of
1,200 notes, and this is since 2017. I mean, so, and I think 2 of them were REOs. So, we actually made money.
We made money on them. It's just we had to
So
work.
because of our discount, remember, we actually made money. And in fact, we actually on those 25 defaults, we actually made profit on all those defaults. So our overall profit was like 30% profit margin on our defaulted loans.
Yeah.
So that's because of the underwriting models.
Yeah. Now that 30% we have to work for, because we have to go fix the problem, whereas the rest of the portfolio, it's just
right.
The checks come in and then, through the servicer and then to us and then to our investors. So that's super easy. But hey, we don't mind default, that we started in defaulted paper. So we know what to do with it.
We eat defaults for lunch. So that's just a yummy meal for us.
Yeah. They're probably more profitable, but you've just got to put a little bit more work into squeezing the juice out of it.
Yes. Do you buy the rental house or do you buy the fixer upper and then rent it out? You got to fix it up. That's work, So anyway.
All right, guys, before we jump into the Freedom 4, what's one last gold nugget for our listeners?
Bob, go ahead.
Golden nugget. I'll tell you what, you're focusing on financial freedom. How do you get really financially free? And truly financially free is truly passive. And to be truly passive, you need to have really good operators, really, really good operators. I would spend, I had a venture capitalist once tell me, he said, no, we never bet on the horse, we bet on the jockey. And so when you're looking at sponsors, get the operators that you really like. They're really smart. Make sure they're well paid, so they have an interest in staying in the game, and let them run. And that's the way to get true freedom. Is don't try and poor boy it. Don't try and eke out the smallest margins, and don't take flyers on operators that are just not the best. Yeah. And there you go.
I'll add my yin to the yang or whatever on that is so obviously all of us on this panel, believe in educating people. So get educated and pick a vertical that you like. You like self-storage, you like apartments, you like mortgage notes, and get educated. Sign up for listen to podcasts, go to a conference or two. But here's the thing. Here's my gold nugget. Take action. Bob's going to be laughing at me. I usually overwork a decision before I make it, but find an operator that you've done some vetting and don't think, maybe a better one will come along. Take a chunk of money. The best way to learn is when you actually have skin in the game. You've not only invested some time to learn, but like, hey, I put 50 grand from my IRA or 100 grand into this apartment syndication. Now I get these quarterly or monthly reports. I get to watch it. I'm going to learn about apartments, or I'm going to learn about notes, or I'm going to learn about whatever it is, and just start. Really, the gold nugget is just start, and it'll start snowballing, and it'll come a point in time where you can maybe leave the day job behind and just enjoy passive income. So,
yeah, at some point you've got to take action. I mean, it's just like betting on a sports game. You're going to pay a lot more attention if you've got skin in the game.
Yeah. More fun to watch too, right?
Yeah. So. All right, let's jump into the Freedom 4.
It's time for the Freedom 4.
What's the best thing you do to keep your mind and body healthy?
I'll go first if you want. So my faith is foundation to my life. That's the most important thing. So I, there's a proverb that says, I'll put it in simple terms, is like, take care of the inner self, take care of your heart. And the stuff that flows out of your life, your physical body, what you touch, what you do, the way you deal with people, there'll be good fruit from that if you watch over the garden of your interior. So as a Christian, that's what I do. And the rest flows from there. Obviously, you got to actually exercise your body for it to be healthy and put the right fuel in it. I'm really big on nutrition and exercise. And I have a wife that super supports me in that. Supports as in kicks my butt. So.
Bob, anything to add?
Yeah, well, I've lost last year 42 pounds and using the Genius foods. So I'm just highly recommend that. It's brain health. It's all about eating for brain health. And hopefully my brain is healthier, so, but it's just that's a great tip for me, at least.
Yeah, that's awesome, man. Congratulations. With all your success, what is one limiting belief that you've crushed along the way, and how did you get past it?
For me, I mean, there was, years ago, I was part of the kind of the hard money crowd and the doomsday, like looking for the next, looking for the shoe to drop, or the cliff you're about to run over. And it seems like everybody's afraid, and I'm telling you that if you're there, that's a ticket on the poverty train. And the truth is, human activity is increasing, GDP is rising, humans adapt. We will always have problems, we'll always have issues and dangers, and humans will always adapt and overcome over time. And so it's, bet on growth, bet on solutions, don't bet on fear. And that really unlocked the wealth for us.
And really going right along with that, it's, there's two ways to look at any challenge that comes your way. One is, oh crap, oh crap, oh crap, oh crap. Another is you see the opportunity, you go, oh boy, oh boy, oh boy. And that's why we love the real estate realm within alternative investments, because honestly, there is a way to position yourself when things are crashing and be hugely profitable. And there's a way to position yourself. Obviously, it's easier when things are going like they've been going, frankly, for the last, several years. And so, you just don't spend a lot of time kicking yourself over, maybe getting off the boat too late when it was going the wrong direction. And you're always looking for which way is opportunity flowing right now. And there always is opportunity, no matter which direction the needle's pointed. So,
yeah. What's one actionable step our listeners can do right now to start creating more freedom?
Take action, buy something, invest.
Yeah, definitely. And buy something passive. That's
what I mean.
There's so many great passive incomes, passive opportunities out there by really top end operators. Do it.
Yeah, that's the great thing about what you guys are doing. I mean, people don't realize that. I mean, people are kind of stuck in that invest in your 401k, mutual funds, stocks, bonds, things like that. And they don't really know anything else. And even if the thought crossed their mind that, hey, I want to diversify, I want to get into alternative investments, they don't know. So we've got to educate them and show them that there are other opportunities out there, great opportunities. Exactly. And there's a bunch of them. And you don't have to do fix and flips to invest. There are passive ways to get into it.
Yeah, and you're getting off the emotional roller coaster. I mean, how many people are checking the stock market, every day and thinking, oh, how much money did I lose? It's like, that's not a roller coaster I'm on,
Yeah.
Last but not least, how has passive income made your life better?
Well, first of all, I'll go first and say, because of where I was 10 years ago, most of my income, has been very active, but it's multiplicative. It's in the business owner quadrant as opposed to the self-employed. And frankly, that's for partnering up with Bob. I think I would have been still in the self-employed quadrant. It would have gone well. But it wouldn't have been a business. It wouldn't have been a company. I mean, Bob and I built a company now that, honestly, I mean, we have such good processes and a team in place that, in a sense, it's passive income through owning a business. But since we're really growing it for the sake of the next generation, we're still very active. But the money that it spits off to us, now we're adding a lot into the passive investor quadrant. So we're looking at people's apartment syndications and self-storage and stuff that's a little bit out of our direct bailiwick. And it's it's great. It's great to just have income coming in, and you're not necessarily, the work that you do for your passive income, you do on the front end. It's your vetting process and your due diligence. And then, you have to manage it too. You have to keep your eye on what the people are doing. Are they doing what they say they're going to do? So I don't know if anything's 100% passive, but anyway, that's my story. Bob?
Long-term cap gains. Makes me happy.
Love it, guys. Thanks so much for coming on the show today. It's been fantastic. Where can our listeners find out more about you?
Aspen, like the tree, funds, FUNDS.US.
No space.
Awesome. Thanks again, guys.
All right.
Pleasure to be
Great
here.
being with you, Seth.
All right, Bob and Jim, thank you so much for coming on the show. True professionals there. These guys are real pros. I partnered with them on a number of deals already, and they know their stuff. They are true experts in the industry. All right, well, check this out. Look, with all this volatility in the stock market, I'm sure you've considered investing in real estate. If you're unsure about how to invest passively or where to find great deals and great sponsors, or don't even know what a syndication is, but you should because you've been listening to my show, I've got something for you. Passive Income Pro. It's a 4-week program guaranteed to give you the knowledge and the confidence you need to invest in your first or your next passive real estate deal. Just go to passiveincomepro.io to get started. All right, kiddos, as always, enjoy the journey.
Thank you for listening to the Passive Income Attorney Podcast with Seth Bradley. Do you want more ideas on how to generate multiple streams of passive income? Then jump over to passiveincomeattorney.com for show notes and resources. Then apply for the private Facebook community by searching for the Passive Income Attorney on Facebook. And we'll see you on the next episode.